There's something your bank does that they absolutely love. They will never ever send you a thank you note for it. They won't mention it in their commercials, but behind the closed doors of their boardrooms, they love it. Because this one simple thing that you're probably doing right now quietly makes them thousands upon thousands of dollars, all while they pay you next to nothing for the privilege. And the craziest part? Fixing it takes about 10 minutes. Welcome to Sketched Finance, the show where we break down the financial system so it stops breaking you. Our philosophy is simple: know the system, beat the system. Today we're talking about the single simplest financial upgrade that most people still haven't made. Let's start with the story. Meet Marcus. Marcus is doing everything right according to the standard advice. He's a responsible guy. He's saved up a solid emergency fund, $14,000, sitting safely in a savings account at one of those huge big-name banks you see on every street corner. He's prepared. He's disciplined. But here's the catch. Do you know what his interest rate is? It's 0.01%. 0.01%. After an entire year of his $14,000 sitting in that account, Marcus earns $1.40. Let me repeat that because it sounds like a typo. Not $140, $1.40. Enough to buy maybe half a cup of coffee. That's not passive income, that is passive disrespect. Now, let's look at the other side of the coin. What is the bank doing with Marcus's money all year? It's not just sitting in a vault with his name on it. Oh no, that money is put to work the second it hits his account. The bank takes his $14,000, bundles it with other deposits, and lends it out. They lend it out as a car loan at 7%. They lend it out as a personal loan at 12%. They use it to fund someone else's credit card balance at a staggering 24%. Marcus gets pocket change. The bank gets a powerful revenue stream built on his money. And none of this is illegal. It's not some shady back alley deal. It is, quite simply, how the system works. When you deposit money, you're not just storing it, you're lending it to the bank. That's their business model. They make their money on something called the interest rate spread. It's just a fancy term for the gap between what they pay you for your money and what they charge other people to borrow your money. Right now, that gap is a canyon. Many big banks pay depositors like Marcus between 0.01% and maybe 0.07%, but they charge borrowers over 6% for a mortgage, 12% for a personal loan, and over 20% on credit cards. That gap, that's their profit machine. And if your savings are sitting in one of those accounts, you are the fuel. But here's the part they don't advertise, the part they hope you never realize. You don't have to be the fuel. You can flip the entire script. Right now, as we speak, there are hundreds of banks, safe, secure, federally insured banks offering something called a high-yield savings account. And their interest rates aren't 0.01%. They're paying around 4%, sometimes even 5% APY. Let's do that math again and see how it changes things. Let's take $10,000 for a round number. In a traditional account at 0.01%, after 1 year, you earn a single dollar, $1. But that same $10,000 in a high-yield savings account at 5%, you earn $500. That's not a typo either. $500 versus $1 for the exact same money with the exact same level of risk. These high-yield accounts have the very same FDIC insurance as the big-name banks, which means your money is protected by the federal government up to $250,000. The only difference is awareness. So if the difference is that huge, why hasn't everyone moved their money? It usually comes down to 3 reasons. First, simple inertia. It's the most powerful force in finance. We open a checking and savings account when we're 18, maybe the one our parents used, and we just never think about it again. We put our finances on autopilot, not realizing that autopilot is programmed to fly straight into the bank's profit center. Second, there's the big bank comfort factor. We see the giant marble building, the familiar logo we've known our whole lives, and we think, that must be safer. But safety for your deposits doesn't come from the size of the building. It comes from 3 letters, FDIC, Federal Deposit Insurance Corporation. And that insurance works exactly the same whether it's at a national chain or a reputable online bank with lower overhead. And third, there's the awareness gap. Most people just don't know that the difference is this dramatic. And why would they? Your bank is never going to send you an email saying, hey, just a heads up, you could be earning 500 times more interest on your savings if you went to our competitor down the street. Of course not. They are counting on you doing nothing. And in the world of finance, doing nothing is one of the most expensive decisions you can make. Let's zoom out and see what this costs over time. Let's go back to an emergency fund, say $15,000. If you keep that in a traditional account, earning a generous 0.07%, you'll make about $10 a year. But in a high-yield account at 5%, you make $750 per year. That's a difference of nearly $3,750. That's a plane ticket, that's a new laptop, that's a significant repair on your car. It's not going to make you a millionaire overnight, but it's momentum. And real wealth isn't built on magic lottery tickets. It's built on momentum. It's built by stacking small, smart decisions on top of each other until they create something substantial. So how do you do it? How do you make this flip? It's a simple 3-step action plan. Step 1. Open a high-yield savings account. Go online and search for FDIC-insured high-yield savings account. You'll find dozens of reputable banks. The application takes about 10 minutes. You'll need your social security number and a driver's license, just like any other bank account. Step 2. Move your money. Transfer your emergency fund and any other extra cash you have sitting around into this new account. Your old checking account is still useful for day-to-day bills, so keep just enough in there to cover your monthly expenses. Everything else goes into the new account where it can finally start working for you. Step 3. Automate it. Set up a recurring automatic transfer from your checking account to your new high-yield savings account every single payday, even if it's just $50, because discipline is powerful, but automation is undefeated. Now, you might be worried about access. What if I need the money quickly? That's a fair question, but most electronic transfers between banks take just one business day. It's not locked away in a vault for years. Some accounts even offer debit cards or ATM access. Your money is still your money. It's just finally being treated with some respect. This is just one example. The financial system is filled with these quiet structures, these default settings that are designed to profit from inertia. Credit card reward systems, employer 401k matches, tax-advantaged accounts. They're all legal, all available, but they are only useful to the people who take the time to understand them. And that's what we're all about. Banks aren't evil, they're just businesses, and they are ruthlessly optimized for their own success. The only solution is to optimize yourself. Know the system, beat the system. Now that you've fixed where your savings sits, the next question is obvious. What's the next small, smart decision? What should you do once your emergency fund is fully optimized and earning real interest? In our next episode, we'll break down the single greatest source of free money in the financial world, the 401k match. Make sure you join us for that. Stacking these smart decisions is how real wealth gets built. I'll see you there.